I do not invest on the basis of what might happen in a very unusual set of circumstances. I mean, there's no precedent for an economy that has been growing this rapidly to sort of autonomously disinflate all the way back to sub 2% inflation. We have no precedent for that. That would be quite an extraordinary and bizarre thing to happen. It is a possibility, of course it is, but I would give it very, very low probability. I think, be very, very wary of forecasts. One should just stick to facts. And the fact is that we've got an underlying inflation problem. As I said in March, it was the strongest US labor market since the late 1990s. In the late 1990s, the Fed funds rate was like 6%. The US economy has been on fire. Now, we know there are supply chain challenges. That doesn't make it any easier. That makes it harder. Unfortunately, monetary policy is a very, very blunt instrument. So one needs to keep your eye on the big picture here. I think, taking material positions based on low probability, optimistic scenarios is a very unwise investment strategy.
Eric, let me ask you about Europe. We have focused this week on news around hedge funds building up these massive short positions, betting against Italian debt. And you talk about sticking to facts. Well, here's a fact. Italy's debt to gross GDP ratio is far higher than in 2010, the lead up to the Euro sovereign debt crisis, at around 150%. Inflation, obviously, very hot in Europe right now as well. What is the fate of Italy, and how concerned should investors be in your view?
We should be concerned. I think actually I may have spoken to you about a year ago about this, and we had very material short positions in BTPs. I have closed those positions though at the current juncture because I think it's no longer a one-way bet, and I think the ECB has constructed a framework that could alter the prospects for Italian debt. But you are right. It is a kind of knife edge, because if you look at the ECB's tools to effectively target or control spreads, the key question is eligibility. Now, all Eurozone sovereigns are currently eligible. They've designed the system so that everyone is eligible. So I think a market panic currently, or a very extreme move in yields, the ECB can come out pretty promptly and apply its new tools. So again, as an investor, I think that's a very risky position today. That was not the case 6 months ago, but it is the case now. As to the medium term, it does concern me, because if Italy loses eligibility, so in other words, there's these criteria associated with imbalances, criteria associated with the fiscal rules. If and when any Eurozone country loses eligibility, then there is a risk of another sovereign problem.
Eric, briefly, what's the moneymaker in your portfolio? Where are you positioned? Where do you think you're going to win big?
Yeah, well, it's not going to surprise you, Jeff, that I am very, very cautiously positioned at the moment. So we've had a very strong year. The hedge fund is up about 12%. That's because I've been doing what I said. In other words, we've been short all assets. We've been short bonds. We've been short equities. I think at the current juncture, it's a lot harder. I have some put options on the S&P 500. I have some very small positions in Chinese equity. China's in the recession. So Chinese equities are behaving in a diversified fashion, but those are small positions. I would be very, very cautious. If you're in a long-only fund, you go to benchmark. If you're at a hedge fund, you should be in cash, and then you have small tactical positions, because this is a very, very risky environment, and the goal is capital preservation.
Wow, Eric, I'm not sure I want to pay those fees if I'm in cash with a hedge fund, but hey.
I don't think you mind paying the fees if you see all other asset prices declining.
Well, we got to go. Eric Lonergan, thank you for being with us, macro hedge fund manager at M&G Investments.